And welcome into Making Sense. There's not a day that goes by that you're probably not going to read a headline in the newspaper or a news story on television or even on the radio that's going to address things that are happening with the Federal Reserve. That's one organization that has a big effect on all of our lives. And my guest today is Brandt McDonald, and you are the founder of McDonald, Barranco, and Hagen. It's a wealth management company.
That's correct.
You're a born and bred Alabamian.
That's true.
Been here all your life.
I
And you've worked in the banking industry a little bit, and then also in securities, have you, before you started went out on your own?
That's correct. I began managing money 25 years ago, and over that time I've had gained quite a bit of experience in many different facets of the investment world, whether it was investment banking or just general research, speaking with research analysts all over the country, meeting with institutional money managers around the country. It's really been exciting, and you get to learn a lot about what truly is going on behind the scenes.
Sure.
And so you gain a lot of experience, I think, in understanding the difference between what these headlines are saying and what's really happening on Wall Street and in the global economic view. And that's where we spend most of our time, is trying to decipher what are these headlines. As a matter of fact, we like to try to anticipate what those headlines will be and not be so reactionary when they finally hit the front page of the newspaper. And that's why we spend so much time trying to understand what is happening with large institutions like the U.S. Federal Reserve System, for example. And it's not just our own Federal Reserve, it's central bankers all over the globe, whether it's Mario Draghi at the European Central Bank, or whether it's Abenomics in Japan, or what have you.
So our viewers will understand when you talk about a central bank.
Right.
Because, and I think most of our perspective is, yes, I go to Regions or I go to Wells Fargo, I go to one of these. A central bank is, to make it for our viewers to understand.
Well, the U.S. Federal Reserve System monitors and regulates all of the money flows that go on in our country. So a lot of like a Regions Bank or some of these that you mentioned, those are money center banks. They're FDIC insured institutions. And I think a good way to understand it is, you know, these banks, those banks, have their own bank. And their bank is the U.S. Federal Reserve.
All right.
So if they have a lot of extra money that they can't lend, or they just don't know what to do with it, for the most part, they will then put it on deposit with their bank, which is the U.S. Federal Reserve System. And the level amounts of money that are in the system are controlled by our Federal Reserve. And they also will pay interest on those deposits to our bank.
That's the important thing.
Right.
Rather than just store it somewhere,
they
have to make some good money bringing it back.
Right.
So today when we're looking at the Federal Reserve, obviously people sit there each day saying, what's it going to do? Is it going to...
Right.
They control interest rates.
Well, they control interest rates. I think one of the most significant things we've seen over the last 5 years was an experiment that's never been tried before in the U.S., and that was, the idea of quantitative easing. And I know that's a term that, I speak quite frequently around this area. And a lot of people ask me, what is this? What does it mean?
Absolutely.
So I think the bottom line there is that, when we had the credit crisis, the Federal Reserve stepped in and felt like, what we need to lower interest rates. That's always sort of the first thing, the first line of defense, if you will, in order to try to grease the tracks. And so they brought interest rates down to effectively zero on what's called the federal funds rate. But it wasn't really having the impact that they would like to have seen. So they tried this new experiment called quantitative easing, and essentially what that is where you create brand new money out of thin air to the tune of almost $85 billion every single month. Now, what they do with that money is they then go out and they enter the U.S. Treasury bond market, and they start to buy Treasury bonds and other fixed income instruments. A lot of what
with this manufactured money.
With this manufactured money, and a lot of it is also mortgage-backed securities. Now, the expressed intent of that is to try to bring interest rates down and control parts of what we call the yield curve, particularly the 10-year Treasury bond, because that's tied to mortgage interest rates.
Okay.
That's what sets the 30-year mortgage rate. So when you see the Federal Reserve active in the Treasury market, aggressively purchasing these 10-year bonds, they bring the yields down, the prices go up. It keeps interest rates low, and it allows people to refinance their mortgages. The problem is that at the end of the day, let's just put it this way, our Federal Reserve is not unlike any other financial institution. They're acquiring assets, and they've acquired over $3.5 trillion of U.S. Treasuries and mortgage-backed securities over the last few years. That's why people ask me all the time, well, what about the debt? Our debt keeps going up. Well, it does. But essentially, our Federal Reserve has been the single largest acquirer of those treasuries of anyone in the world. And I think that at the end of the day, the great concern we have is how much new money has been put into the system, $3.5 trillion, that has devalued our currency. And we anticipate that once that money starts to move around in the system and gain velocity, that we will see the general level of prices begin to go up dramatically. And I think that's the real impetus, that's the impact and the concern we have when it comes to this quantitative easing. Here recently, a new term has been introduced called tapering.
Okay.
And essentially what they're referring to there is the fact that the Federal Reserve has decided that this quantitative easing program is not really having the impact that they would like it to.
What a surprise.
It's inflated real assets, and it's helped people who own stocks, it's helped people who own bonds and real estate and other things, but it's not finding its way into middle America. It's not really getting into the pocketbooks
the way it's
of those
to.
who really need it. I think that they realize, just like in past events, they may be creating a bit of a bubble here, and they may be creating what we call unintended consequences. So the word taper means it's time for them to think about exiting this strategy before they create it. Just taper it down.
If you're the smoker, you're going to taper off smoking.
That's right.
That's right. Fewer cigarettes.
That's exactly right.
It's interesting because when you're talking about, because we all say, ooh, the stock market is doing very well. Record levels, but yet the economy is. So that's what you're talking about, the bubble.
That's right, and we see it showing up all over the place. You know, even in retail sales. When you look at retail sales of luxury goods items have exploded. But sales of just basic common staples goods items have not really moved that much.
That's right.
The QE program has helped people who have quite a bit of money already. And it's unfortunate because those people who don't have money in real investment assets, whether it's real estate, stocks, commodities or bonds, have not experienced this huge, move up that we've seen in asset prices. And again, the question begs itself, what happens now that the Fed starts to slow down or taper their QE program? Does that impact stock prices? Does that impact asset prices? And again, this is an untried experiment, so we're all going to find out pretty soon.
We're going to get you to come back next week because we're going to talk a little bit more about this QE.
Yes.
We hear the term, but most people are saying, well, what is this?
Yes.
And just remember this, that the Federal Reserve is there. It's supposedly a monitor to make sure that everything is working in the right direction. Hopefully, like everything else, it's going to work to your advantage and our advantage. And we'll be right back right after this.